Question 1. Which of the following is a significant difference between a standard title insurance policy and an extended coverage policy? A. Extended coverage policies include protection against claims for forged documents, whereas standard policies do not. B. Standard policies cover the cost of defending against adverse possession claims, while extended policies do not. C. Extended coverage policies include protection against zoning and land use restrictions, while standard policies exclude this coverage. D. Standard policies provide coverage for legal descriptions that are ambiguous, whereas extended policies do not. Answer. C. Explanation. An extended coverage title insurance policy offers broader protection than a standard policy. This includes coverage for zoning and land use restrictions, which are typically excluded from standard policies. The extended policy may also cover risks such as forgery, which a standard policy might not. However, it is essential to understand that while extended policies offer additional coverage, they still exclude some specific risks that may be covered under specialized endorsements. Relevant rule. Title insurance policies are structured according to the guidelines provided by the American Land Title Association, author. Standard and extended policies are defined under ALTA standards, with extended policies offering enhanced coverage as per the ALTA 2006 extended coverage policy. Question 2. Which of the following is true about the chain of title during a title search? A chain of title refers to the historical sequence of ownership of a property, which must be uninterrupted to ensure clear title. B. The chain of title only includes recorded documents, excluding unrecorded transfers that could impact the property's ownership. C. A chain of title is only relevant for properties that have been transferred multiple times within the last 5 years. D. The chain of title is a summary of property tax payments and does not affect title insurance coverage. Answer A. Explanation. The chain of title is a fundamental concept in title insurance and real estate law. It tracks the sequence of ownership transfers and ensures that the property title has been consistently clear of issues. An uninterrupted chain of title is crucial for establishing that no claims or defects affect the current owner's rights. It includes all recorded documents and may also need to consider unrecorded transfers if they impact title validity. Relevant rule. The process of title searching involves reviewing the chain of title to identify potential issues such as breaks in ownership or unresolved claims. This is essential for preventing title defects that could affect the buyer's ownership rights. The ALTA guidelines require thorough examination of the chain of title to ensure comprehensive coverage. Question 3. Scenario-based. Mr. Thompson is purchasing a commercial property in Arkansas. During the title search, the title examiner discovers an easement that was not recorded in the public records but is mentioned in a neighboring property's deed. What should Mr. Thompson do to address this issue before closing the transaction? A. Ignore the unrecorded easement since it is not listed in the public records and proceed with the purchase. B. Request a formal confirmation from the property seller that the easement does not affect the commercial property and proceed with the purchase. C. Negotiate with the seller to have the unrecorded easement removed or have it recorded properly to ensure clear title before closing. D. Proceed with closing and file a claim with the title insurance company if the unrecorded easement affects the property's use or value after the purchase. Answer. C. Explanation. In real estate transactions, unrecorded easements can pose significant issues. Mr. Thompson should ensure that the easement is either recorded properly or resolved before closing to avoid future disputes or limitations on the property. It is essential to address these issues proactively to ensure that the title insurance provides adequate protection against potential claims related to the easement. Relevant rule. According to Arkansas title insurance regulations and general practices, title defects such as unrecorded easements must be resolved prior to closing. The title insurance policy will not cover such issues unless they are addressed before the transaction is completed. Ensuring all easements are recorded and properly handled is crucial for maintaining clear title. Question 4. Which of the following best describes the role of a title insurance underwriter in evaluating a title risk? A. The underwriter verifies that all past ownership transfers have been properly recorded but does not assess potential future risks. B. The underwriter assesses the risk of the title based on historical ownership and current property conditions and decides the terms of coverage. C. The underwriter only confirms that the property complies with local zoning laws and does not address title defects. D. The underwriter is responsible for handling claims after the policy has been issued, rather than assessing risks before issuing the policy. Answer. B. Explanation. The role of a title insurance underwriter involves assessing the risk associated with a property's title based on its historical ownership and current conditions. This includes evaluating potential title defects and determining the appropriate terms of coverage for the policy. Underwriters ensure that the title is clear and free from issues that could affect the policyholder's rights. Relevant rule: title insurance underwriting involves a comprehensive review of the property's chain of title, legal descriptions, and potential risk factors as per ALTA underwriting guidelines. The underwriter's evaluation is crucial for determining policy coverage and protecting against title defects. Question 5. In the context of title insurance, which of the following statements is true regarding easements and encroachments? A. Easements are rights to use another person's property for a specific purpose and are always recorded in public records. Encroachments involve a physical intrusion onto another property. B. Easements do not need to be recorded to be enforceable, whereas encroachments are considered non-existent unless documented. C. Easements and encroachments are both covered under standard title insurance policies without any exceptions. D. Encroachments are considered legal rights to access adjacent properties, while easements are illegal unless explicitly recorded. Answer A. Explanation. Easements are legal rights to use another person's property for a specific purpose and are typically recorded in public records to provide notice to future property owners. Encroachments involve a physical intrusion onto another property, which may not always be recorded but can still affect title. Both can impact title and may need to be addressed through title insurance policies. Relevant rule: the ALTA title insurance policies typically cover easements and encroachments that are known and recorded. Encroachments that are not recorded but affect the property's use or value may present issues that need to be investigated and resolved before issuing a policy. Question 6. When a title insurance claim involves a fraudulent deed, which of the following actions is typically taken by the title insurance company? A. The title insurance company immediately denies the claim as fraudulent deeds are not covered under any circumstances. B. The title insurance company investigates the claim, assesses the impact of the fraudulent deed, and may cover the loss if the policy includes such protection. C. The title insurance company refers the case to local law enforcement but does not provide any financial coverage for losses resulting from fraudulent deeds. D. The title insurance company offers partial compensation based on the current market value of the property affected by the fraudulent deed. Answer B. Explanation. In cases involving fraudulent deeds, the title insurance company will investigate the claim to determine its validity and the impact on the title. If the policy includes coverage for such issues, the company may provide compensation for the loss. Fraudulent deeds are generally covered under title insurance policies, but the specific coverage depends on the terms and endorsements included in the policy. Relevant rule: title insurance policies often include coverage for defects such as fraud as outlined in ALTA policies. The insurer's role is to protect against financial loss resulting from covered defects, including fraudulent deeds. Question 7. Which of the following best explains the statute of frauds as it applies to real estate transactions? A. The statute of frauds requires that all real estate transactions be executed with a written document to be enforceable. B. The statute of frauds allows verbal agreements for real estate transactions if they are witnessed by a notary public. C. The statute of frauds applies only to commercial real estate transactions and not to residential transactions. D. The statute of frauds invalidates any real estate transaction that is not completed within a specific time frame. Answer A. Explanation. The statute of frauds mandates that certain types of contracts, including those related to real estate transactions, must be in writing to be enforceable. This statute aims to prevent fraudulent claims and ensure that significant agreements are documented. Relevant rule: in Arkansas, as in other states, the statute of frauds requires that contracts for the sale or transfer of real estate be in writing to be enforceable. This requirement helps ensure clarity and prevent disputes over verbal agreements. Question 8. What is the primary purpose of an abstract of title in the title examination process? A. To summarize the property's history, including all recorded documents and events affecting the title. B. To provide a detailed report of all property taxes paid by the current owner. C. To outline the current market value of the property and its potential for future appreciation. D. To list all pending legal disputes related to the property that might affect title. Answer A. Explanation. An abstract of title provides a comprehensive summary of the property's history, including all recorded documents and events that have affected the title. This summary is crucial for identifying any issues or defects that need to be resolved before issuing a title insurance policy. Relevant rule: the abstracting process is a key component in title examination and is used to create a detailed record of ownership history and related legal documents. This helps ensure that the title is clear and free of defects. Question 9. How does the Dodd-Frank Act impact title insurance practices? A. The Dodd-Frank Act establishes standards for the disclosure of settlement costs and the conduct of title insurance companies. B. The Dodd-Frank Act exclusively governs the issuance of title insurance policies for commercial properties. C. The Dodd-Frank Act eliminates the requirement for title insurance in residential real estate transactions. D. The Dodd-Frank Act mandates that title insurance premiums be regulated solely by state laws. Answer A. Explanation: the Dodd-Frank Act includes provisions that impact the disclosure of settlement costs and practices for title insurance companies. It aims to increase transparency and protect consumers by requiring detailed disclosures about the costs and terms associated with title insurance. Relevant rule: the Dodd-Frank Wall Street Reform and Consumer Protection Act affects various aspects of real estate transactions, including title insurance. It establishes guidelines for disclosures under the Real Estate Settlement Procedures Act, RESPA, and Consumer Financial Protection Bureau (CAB) regulations. Question 10. What is the primary difference between involuntary and involuntary liens? A. Voluntary liens are created by the property owner's consent, while involuntary liens are imposed without the owner's consent. B. Voluntary liens are always recorded, whereas involuntary liens are never recorded. C. Voluntary liens can only be for property taxes, while involuntary liens cover all other types of debt. D. Involuntary liens are created through legal agreements between two parties, while voluntary liens arise from public statutes. Answer A. Explanation: voluntary liens are liens that a property owner agrees to, such as a mortgage or a loan secured by the property. Involuntary liens are imposed by law without the property owner's consent, such as tax liens or judgment liens resulting from legal actions. Relevant rule: in Arkansas, as in other states, the distinction between voluntary and involuntary liens is crucial for understanding property rights and title insurance coverage. Voluntary liens typically arise from agreements made by the property owner, while involuntary liens are imposed due to legal or statutory reasons. Question 11. Scenario-based. MS. Carter is closing on a residential property purchase. During the final review, she discovers a tax lien that was not previously disclosed and is not mentioned in the title commitment. What is the most appropriate action for MS Carter to take before proceeding with the closing? A. Proceed with the closing and address the tax lien issue after the purchase is completed. B. Request that the seller resolve the tax lien before closing, or negotiate with the seller to ensure the lien is cleared or accounted for in the closing process. C. Ignore the tax lien as it is likely to be resolved automatically by the title insurance company after closing. D. Cancel the closing immediately, as tax liens automatically invalidate the property's title and cannot be resolved. Answer B. Explanation. MS. Carter should ensure that the tax lien is resolved or properly accounted for before closing. Tax liens can affect the title and may need to be addressed by the seller or factored into the closing arrangements. It is essential to resolve such issues to ensure clear title and avoid potential disputes. Relevant rule: in Arkansas, unresolved tax liens can impact the closing process and the property's title. Title insurance policies generally cover such issues, but they must be addressed before the closing to ensure that the title is clear and the policy provides adequate protection. Question 12. What is the primary purpose of a title commitment in the title insurance process? A. To provide a preliminary report on the title, including legal descriptions, parties involved, and exceptions from coverage before issuing a final policy. B. To finalize the terms of the title insurance policy and the premium amount based on the closing date. C. To summarize the financial obligations of the buyer, including property taxes and mortgage payments. D. To confirm the property's market value and offer a property appraisal. Answer A. Explanation. A title commitment is a preliminary document that outlines the terms and conditions under which a title insurance policy will be issued. It includes the legal description of the property, the parties involved, and any exceptions or exclusions from coverage. This commitment helps identify potential issues with the title before the final policy is issued. Relevant rule: According to ALTA standards, a title commitment provides essential information about the title status and the conditions required to issue a final title insurance policy. It ensures that both the insurer and the insured are aware of any title defects or exceptions. Question 13. Which of the following best describes the difference between the standard coverage and extended coverage in title insurance policies? A. Standard coverage protects against title defects that are recorded in public records, while extended coverage includes additional protection against defects not recorded but discoverable through a title search. B. Standard coverage includes protection against all potential title defects, while extended coverage only covers defects known at the time of policy issuance. C. Standard coverage offers protection against legal disputes, while extended coverage is limited to financial losses resulting from title defects. D. Standard coverage is typically more expensive than extended coverage due to broader protection. Answer A. Explanation. Standard coverage in title insurance protects against title defects that are recorded in public records, such as liens or claims. Extended coverage offers additional protection against defects not recorded but that may be discovered through a thorough title search, including certain off-record matters. Relevant rule. ALTA policies distinguish between standard and extended coverage, with extended coverage providing broader protection. Extended policies cover more potential risks and defects that are not immediately apparent in public records. Question 14. What is the role of a title examiner in the title insurance process? A. To conduct a detailed review of the title history and identify any defects or issues that need to be addressed before issuing a title insurance policy. B. To handle the financial transactions and fund disbursement during the closing process. C. To appraise the value of the property and determine the insurance premium based on the property's market value. D. To negotiate the terms of the title insurance policy with the buyer and seller. Answer A. Explanation. A title examiner reviews the property's title history, including all recorded documents and ownership transfers, to identify any defects or issues that need to be resolved before issuing a title insurance policy. This role is crucial for ensuring that the title is clear and free from problems. Relevant rule. Title examiners follow guidelines to review and analyze the title chain, identify potential issues such as unrecorded deeds or heirs in public records, and prepare a report to guide the issuance of the title insurance policy. Question 15. How does the Real Estate Settlement Procedures Act (RESPA) impact title insurance transactions? A. RESPA mandates disclosure of settlement costs, including title insurance premiums, to ensure transparency in real estate transactions. B. RESPA exempts title insurance companies from providing any disclosures related to settlement costs. C. RESPA regulates the interest rates charged for title insurance policies and requires approval from state insurance departments. D. RESPA allows title insurance companies to offer rebates and incentives to homebuyers for purchasing their policies. Answer A. Explanation. RESPA requires disclosure of all settlement costs, including title insurance premiums, to ensure that buyers and sellers are fully informed about the costs involved in a real estate transaction. This regulation aims to promote transparency and protect consumers. Relevant rule. RESPA is a federal law that governs various aspects of real estate transactions, including the requirement for clear disclosure of settlement costs through forms such as the closing disclosure. C. Question 16. What is the significance of a chain of title in title insurance? A. Chain of title refers to the sequential record of property ownership transfers essential for verifying the current owner's legal right to the property. B. Chain of title indicates the financial history of the property, including mortgage payments and loan balances. C. Chain of title is a list of all previous tenants who have occupied the property and their rental agreements. D. Chain of title documents the history of property taxes paid and any associated liens or penalties. Answer A. Explanation. The chain of title is the record of all historical transfers of property ownership. It is crucial for verifying the current owner's legal right to the property and identifying any potential title defects or issues that need to be addressed before issuing a title insurance policy. Relevant rule. Reviewing the chain of title is a fundamental part of the title examination process. It helps ensure that the title is clear and that there are no unresolved issues affecting the current ownership. Question 17. In title insurance, what does coverage for defects typically include? A. Protection against defects that are recorded in public records, such as liens and claims, but not necessarily against off-record issues. B. Comprehensive coverage for all potential defects, including both recorded and unrecorded issues, regardless of their nature. C. Coverage only for issues disclosed during the title search, excluding any defects discovered after policy issuance. D. Limited coverage that excludes any defects related to boundary disputes or zoning violations. Answer A. Explanation. Title insurance typically covers defects that are recorded in public records, such as liens, claims, and encumbrances. Extended policies may provide additional coverage for certain off-record issues, but standard policies primarily address recorded defects. Relevant rule. ALTA title insurance policies outline the scope of coverage, including the types of defects covered and any exceptions or limitations. Understanding the extent of coverage helps in assessing the protection provided by the policy. Question 18. What is an encumbrance in the context of real estate and title insurance? A. An encumbrance is a claim, lien, charge, or liability attached to a property that may affect its value or transferability. B. An encumbrance is a certificate of authenticity for the property's historical significance or architectural value. C. An encumbrance is a document that confirms the property's compliance with local building codes and zoning regulations. D. An encumbrance is a formal agreement between neighbors regarding property maintenance and landscaping. Answer A. Explanation. An encumbrance is a claim, lien, charge, or liability attached to a property that can affect its value or transferability. Common encumbrances include mortgages, easements, and property tax liens. These issues need to be addressed to ensure clear title. Relevant rule. Encumbrances are reviewed during the title examination process to ensure that they do not adversely affect the property's title. Title insurance provides protection against certain encumbrances that may impact the property's value or ownership. Question 19. Which of the following is typically considered an exception? A title insurance policy's Schedule B. A. An exception is a specific issue or defect that is not covered by the policy, such as certain easements or encroachments. B. An exception is a standard feature of all title insurance policies, providing automatic coverage for common title issues. C. An exception is a required disclosure of the property's market value and tax assessments included in the title policy. D. An exception is a guarantee of protection against all potential legal claims related to the property's title. Answer A. Explanation. In a title insurance policy, Schedule B lists exceptions that outline specific issues or defects that are not covered by the policy. These exceptions may include certain easements, encroachments, or other encumbrances that affect the property. Relevant rule. Schedule B of an ALTA title insurance policy details exceptions from coverage and helps clarify what the policy does not cover. Understanding these exceptions is crucial for evaluating the extent of protection provided by the policy. Question 20. Scenario-based question. Mr. Thompson is purchasing a commercial property and discovers that there is an unrecorded deed related to the property that was not mentioned in the title commitment. What should Mr. Thompson do to address this issue? A. Proceed with the purchase without concern, as unrecorded deeds do not typically affect the title insurance coverage. B. Request that the seller provide additional documentation or resolve the issue with the unrecorded deed before completing the purchase. C. Assume that the unrecorded deed is a minor issue and ignore it, as title insurance will cover any related claims. D. Cancel the transaction immediately, as unrecorded deeds automatically invalidate the title insurance policy. Answer B. Explanation. Mr. Thompson should request that the seller provide additional documentation or resolve the issue related to the unrecorded deed before finalizing the purchase. Unrecorded deeds can affect the title because they may indicate outstanding claims or interests that are not yet formally recorded in public records. Addressing these issues ensures that the title is clear and that the title insurance policy will provide adequate coverage. Title insurance is designed to protect against defects in title, but these protections are contingent on the accurate and complete disclosure of title information. Therefore, resolving the issue with the unrecorded deed is crucial to prevent potential future disputes and to secure proper title coverage. Question 21. What does marketability of title refer to in real estate transactions? A. The ease with which a property can be sold based on its legal title being clear of defects and encumbrances. B. The market value of a property determined by recent sales of comparable properties. C. The availability of financing options for purchasing the property based on its title. D. The potential rental income that a property can generate for its owner. Answer A. Explanation. Marketability of title refers to how easily a property can be sold or transferred based on its title being clear of defects and encumbrances. A marketable title is free from significant legal issues that would deter a reasonable buyer from proceeding with the transaction. Relevant rule: title insurance policies and the title examination process ensure that the title is marketable by addressing any defects or issues that could affect the property's sale or transferability. Question 22. Which of the following best describes an easement in real estate? A. A right to use a portion of another person's property for a specific purpose, such as access or utilities. B. A type of financial lien placed on the property due to unpaid taxes or debts. C. A legal document that guarantees ownership rights of a property. D. A restriction on the type of structures that can be built on a property. Answer A. Explanation. An easement is a legal right to use a portion of another person's property for a specific purpose, such as accessing a landlocked parcel or placing utility lines. It does not grant ownership of the property but allows certain uses by the easement holder. Relevant rule: easements must be clearly defined and recorded to ensure that they are recognized and enforceable. Title insurance typically covers certain types of easements but may exclude others. Question 23. In the context of title insurance, what is a mechanic's lien? A. A lien placed on a property by a contractor or subcontractor for unpaid work or materials provided to improve the property. B. A lien imposed by the government for unpaid property taxes or other municipal charges. C. A lien created by a judicial court following a legal judgment against the property owner. D. A lien related to a mortgage foreclosure proceeding on the property. Answer A. Explanation. A mechanic's lien is a legal claim against a property by a contractor or subcontractor who has not been paid for labor or materials used in improving the property. It ensures that those who contribute to the property's value are compensated. Relevant rule: mechanic's liens can be filed and enforced against the property, potentially affecting its marketability. Title insurance often provides coverage against such liens, ensuring that they do not impair the title. Question 24. What is the purpose of a title insurance endorsements? A. To modify or expand the coverage of the standard title insurance policy to address specific issues or needs related to the property. B. To confirm that the title insurance policy has been paid in full and is active. C. To summarize the terms and conditions of the title insurance policy without altering its coverage. D. To provide a general overview of the property's legal history and ownership transfers. Answer A. Explanation. Title insurance endorsements are used to modify or expand the coverage of a standard title insurance policy. They address specific issues or unique needs related to the property, such as covering additional risks or changing policy terms. Relevant rule: ALTA endorsements can provide additional protection not included in the base policy. They must be requested and approved to ensure that they are properly added to the title insurance coverage. Question 25. Which of the following is typically considered a voluntary lien? A. A lien placed on the property by the property owner as security for a debt, such as a mortgage or home equity loan. B. A lien imposed by the government for unpaid property taxes. C. A lien resulting from a court judgment against the property owner. D. A lien arising from unpaid municipal charges like water or sewer fees. Answer A. Explanation. A voluntary lien is one that the property owner willingly places on their property as security for a debt, such as a mortgage or home equity loan. It is recorded to secure the lender's interest in the property. Relevant rule: voluntary liens are recorded and typically appear on the title report. They affect the title by creating a claim against the property that must be resolved upon sale or transfer. Question 26. In title insurance, what is an adverse possession? A. The legal process by which a person gains ownership of property through continuous and hostile use without permission from the original owner. B. A legal claim by a tenant for ownership rights after a long-term lease period. C. The transfer of property rights through inheritance or legal succession. D. The process of challenging the validity of a property deed based on fraudulent activities. Answer A. Explanation. Adverse possession allows an individual to gain legal ownership of property by continuously and openly using it without the original owner's permission, typically for a statutory period. It requires the use to be hostile, actual, continuous, and exclusive. Relevant rule: the laws governing adverse possession vary by state but generally require specific conditions to be met for the possession to be legally recognized and result in ownership. Question 27. What is the purpose of a quiet title action? A. To resolve disputes and clear any defects or claims against a property's title, establishing the rightful owner. B. To enforce payment of property taxes and municipal liens against the property owner. C. To confirm the property's market value and determine appropriate insurance coverage. D. To negotiate and settle outstanding mortgage payments with the lender. Answer A. Explanation. A quiet title action is a legal proceeding used to resolve disputes and clear any defects or claims against a property's title. It establishes the rightful ownership of the property and ensures that the title is free from competing claims. Relevant rule. Quiet title actions are used to address and rectify title issues such as conflicting claims or defects, ensuring that the title is clear and marketable. Question 20. Which of the following would NOT typically be covered under a standard title insurance policy? A. Unrecorded easements or rights of way that affect the property. B. Errors or omissions in the public records related to the property. C. Claims of ownership based on adverse possession. D. Theft of the property by a fraudulent deed. Answer A. Explanation. Unrecorded easements or rights of way are typically not covered under a standard title insurance policy. Standard policies generally cover defects recorded in public records but may exclude certain off-record matters. A relevant rule. Title insurance policies have specific exclusions and exceptions outlined in the Schedule B section. Extended coverage policies may address some of these excluded matters, such as unrecorded easements. Question 29. What is the primary role of the title underwriter in the title insurance process? A. To assess the risk associated with issuing a title insurance policy and decide the terms and conditions of coverage. B. To conduct the closing and settlement process, including fund disbursement and document recording. C. To provide legal representation and resolve disputes related to title defects. D. To offer property appraisals and determine the value for insurance purposes. Answer A. Explanation. The title underwriter assesses the risk associated with issuing a title insurance policy. They evaluate the title search results and decide the terms and conditions of coverage based on potential risks and issues related to the property. Relevant rule. Title underwriting involves reviewing the title report, determining the insurability of the title, and establishing the terms of coverage to protect against identified risks. Question 30. Scenario-based. MS. Martinez is closing on a property and discovers that a tax lien was filed against the previous owner but is not yet resolved. How should she proceed to ensure her title insurance policy is protected? A. Ignore the tax lien as it will not affect her title insurance coverage. B. Request that the seller resolve the tax lien before closing to ensure clear title and avoid any issues with her title insurance policy. C. Proceed with the purchase and rely on the title insurance to cover any claims related to the tax lien. D. Cancel the transaction as unresolved tax liens automatically invalidate the title insurance policy. Answer B. Explanation. MS. Martinez should request that the seller resolve the tax lien before closing. Tax liens can affect the title and must be resolved to ensure that the title is clear and that the title insurance policy provides adequate protection. Addressing the lien beforehand prevents potential future issues and ensures that the policy will cover any remaining risks. A relevant rule. Tax liens are considered encumbrances that must be addressed to ensure clear title. Title insurance may cover certain liens, but resolving such issues before closing ensures that the title is free from complications.